Greetings and salutations. Today we're going to look at the company UnitedHealth Group, headquartered in the United States and traded on the New York Stock Exchange under the ticker UNH. Please stay tuned for the important disclosure information at the conclusion of this video. UnitedHealth is the largest healthcare provider by revenue. The company is vertically integrated. It controls about 20% of the health insurance premiums market and employs about 10% of U.S. physicians. Also, it provides pharma services to about 20% of Americans. And its data analytics department manages about a third of all health patient records. As for revenues, about 77% came from insurance fees, 13% from products, such as the pharma business, and the remaining 9% from services, including analytics and healthcare. Revenue compound annual growth rate since 2006 hovers around 10%. 5-year compound annual growth rate in 2024 was 11%. By acquiring a pharmacy benefit manager in 2015, the composition of revenues saw a dramatic shift in revenue streams, increasing the role of products from about 3% to 11%. The long-term average margin for health insurance premiums is about 18.3%, which is within the legally allowed margin of 20%. Margin for the product's revenue stream is about 10%. And the cash flow from operations margin averages to 6.9%. This number saw troughs of low 5% during bad times and peaks of high 8% during good times. The composition of health insurance premiums also changed through time. There are 4 major categories: private domestic, private global, government Medicare, and government Medicaid. As of 2024, the company has dramatically reduced its private global revenue stream, thus, we will consider it obsolete going forward. Private domestic revenue grew by about 5% compound annual growth rate, yet was outpaced by government streams, and reduced its share from 48% in 2010 to 25% in 2024. Both Medicare and Medicaid grew much faster and increased their share from a combined 52% to 74%. Thus, at this moment, the government provides more than half of the total revenue of the company. 5-year compound annual growth rate in 2024 for private domestic premiums was at 5.5%, Medicare at 10.9%, and Medicaid at 13%. If we decompose the composition of this growth, private domestic grew predominantly by increasing revenue per customer, whereas both Medicare and Medicaid increased the number of customers at about 4.5 to 4.7% and revenue per customer at 6 to 8% per year. We can also notice that customer acquisition of Medicare and Medicaid customers reduced from about 10% in 2015 at a rate of about 9% per year. For insurance companies, cash reserves increase and newly issued debt are an integral part of the available cash flow. Therefore, we will look at the allocation of cash flow from operations plus net issuance of debt. In the 10-year period between 2006 and 2015, 29% of available cash flow was allocated to operations, 37% to growth acquisitions, and 35% returned to shareholders. In the subsequent 9-year period between 2016 and 2024, the proportions look like this: 29% to operations, 33% to growth acquisitions, and 35% returned to shareholders. We can expect these proportions continue to remain similar in the future. Total debt averaged 2.2 times the cash flow from operations in the first period, and 2.4 times in the second. It boosted available cash flow by 37% and 25% respectively. This can be partially explained by tapping into cash reserves and thus depleting them from an average of 1.6 times cash flow from operations to 1.0. The yearly growth of the capital return to shareholders matches the growth in revenues. However, the composition of it changed from almost entirely shares buybacks in 2006 to an even split between buybacks and dividends in 2024. Because of this, we see a slowdown in dividend growth that now matches the growth of revenue. CEO Stephen Hemsley was appointed in 2025, however, he had previous experience running the company between 2006 and 2017. He owns 0.12% of the company, totaling $342 million, with an annual compensation of about $1 million. Overall, individual insiders control 0.2% of the company. The general public owns 13% of the company, while 87% belongs to institutional investors. As heavily discounted valuable assets do not exceed all liabilities, the liquidation value is estimated at $0. Now let's estimate the intrinsic value of the business using a scenario-based discounted dividends model. The assumptions will include the following. The discount rate is 8%. Private domestic insurance fees will continue to grow at 5% per year, fueled by growth in revenue per customer. Private global fees will be eliminated completely. Both Medicare and Medicaid will continue to grow revenue per customer at 5%. And, as before, growth in the number of Medicare and Medicaid customers will be reducing geometrically from the current 4.6% in 2025 by 9% per year. Services and products will continue to grow at 13% and 9% per year, respectively. Cash flow from operations margin is assumed to be 6.9%, a long-term average. Total debt will be kept at 2.3, and cash reserves at 1.2 times the cash flow from operations. Allocation of cash flow from operations and newly issued debt will follow the historic allocations we discussed above, except for the dividends and buybacks. For Scenario 1, the dividends will continue to grow at 9% per year, and the remainder of available funds will be spent on buybacks. With these assumptions, the discounted dividend intrinsic value of the company by year 2075 is estimated at $715. If the company loses 15% of Medicaid customers instantly due to the new regulations and is prevented from increasing the number of Medicare and Medicaid customers, thus growing insurance fees by only 5% per year, the intrinsic value by year 2075 drops by $123 to $592. If insurance fees revenue per customer yearly growth reduces from 5 to 4%, the value drops by an additional $31 to $561 by 2075. On the other hand, if we cap the growth of products and services at 5%, from the current 9% and 13%, the intrinsic value dramatically drops to $380, indicating the vital importance of these branches of business. Finally, if the company loses 15% of Medicaid customers and, for whatever reason, is prohibited from making new acquisitions so that it can grow revenue only by 5% compound annual growth rate, the intrinsic value drops by $2 to $713. Why? In all our previous models, the company allocated 34% of available funds to acquisitions. Rechanneling it into dividends and buybacks compensates for the loss of revenue streams. We looked at 5 different scenarios to estimate the intrinsic value per share. The price at the moment of this video recording suggests that the revenue growth will slow down to 5% from the current 10%, along with the continuation of 34% allocation of available cash flow into new acquisitions. Scenarios 2, 3, 4. But, if the growth continues along with the current trends, the intrinsic value is estimated at $715 in Scenario 1. In Scenarios 2 and 3, we looked at the reduction in insurance fees revenue, bringing the intrinsic value to $561 to $592. Scenario 4 showed the vital importance of products and services revenue streams, as their reduction to 5% compound annual growth rate reduces the intrinsic value to $380. This scenario still assumes the 34% allocation of available capital into acquisitions. If, as in Scenario 5, the company fully rediverts all capital from acquisitions into dividends and buybacks, growing all revenues only at 5% per year, the intrinsic value jumps to $713, a number very similar to the base case Scenario 1. Thank you so much. Research like this takes a lot of time. If you enjoyed it, please like, subscribe, and consider supporting us. Please note that this video is for entertainment purposes only. We are not financial advisors. This video is not financial advice and should not be considered as such. This video does not provide any recommendations and does not endorse any decisions to buy, sell, or hold any security. We do not guarantee the accuracy or the completeness of the data provided in the video. We are not responsible or liable for any decision, damages, or losses the viewers may take or incur due to negligence or otherwise, based on any interaction, directly or indirectly, with this video. Past performance is not an indicator of future returns. The viewers are encouraged to seek independent legal, financial, taxation, or other professional advice for any action they might take.